call it advanced QSBS planning knowledge, which is they have the trust planning strategies, rollover knowledge, all of these things sort of at their disposal that they can speak to. But it's a very small network. Our firm is actually the only non-CPA, non-law firm in the country that deals directly with founders on these. And so we end up kind of playing quarterback, connecting them with the right attorneys, maybe the right CPA if they don't have one, to make sure that the team is sort of assembled.
Welcome back to the Wealth Actually podcast, the show that features experts, entrepreneurs, and commentators that will give you the right knowledge, planning, and guidance so you can preserve your assets and enjoy your wealth. Learn more and subscribe today at wealthactually.com.
This podcast is for educational and entertainment purposes. It is neither investment, legal, nor tax advice. It does not represent the opinions of the employers of the host or guest.
Welcome back. I'm Fraser Rice. We talked about the nuts and bolts of QSBS and what founders can do with it from a tax perspective in a previous episode with Michael Arleen. Today, we're going to talk to BRADY WELLER about QSBS Rollovers and this powerful tool that founders can use to roll over their QSBS status into new and different forms. Welcome aboard, Brady.
Hey, Fraser. Thanks for having me.
Well, you are the nice complement to a piece I just did with Michael Arleen on QSBS. We covered some of the nuts and bolts around 1202. You come at it from a little bit different angle, and it's usually where people, founders especially, have issues sort of complying with things like the 3 and 5 year rule and otherwise really maximizing the capability of the rollover and the tax significance for it. Maybe tell us a little bit about who benefits and what you do here.
Yeah, QSBS is by far the biggest tax exemption available to individual taxpayers in the U.S. So there's not a massive advisory network around it. So it's not something that's been taken advantage of, I think, to its full scope. So folks like Michael, who you had on recently, is probably the top trust and estate planner for founders of companies around QSBS out there. The specific problem that QSBS rollovers solve and who they're for, so to speak, is a shareholder of an early stage company, most often founders or very early investors, say maybe Series A or earlier shareholders. It's an incentive to basically hold your stock for a quote unquote long time. In this sense, that means, now under some new rules, basically 3 to 5 plus years. And so it's a tax exemption available to folks who hold their stock for at least 5 years, taking on then the ability to exclude from federal income tax now up to $15 million of gains when they sell that stock. So you have to be a shareholder in an early stage C corporation, early stage company.
So for those founders that are facing their liquidity event before 3 to 5 years or are trying to figure out how to maximize a little bit more, what are the challenges that they have to deal with in terms of making sure they don't blow up the transaction by transferring something poorly or, having their company grow too large or have too much cash or those types of things? Maybe list out a little bit some of the challenges that are out there that a founder needs to be aware of.
Yeah, and so that we don't have to constantly caveat, I should just say that I'll mainly talk as though we're speaking about the pre-July 5th, 2025 rules for QSBS. Any stock issued after that date, middle of last year, is under a slightly different set of rules, more expanded rules. But I'll just speak to this sort of from those old rules. And so the old rules state that you have to hold your stock for at least 5 years. And if you do, you can exclude a large portion from federal income tax, usually $10 million for founders. But if you don't hold the stock for 5 years, say you sell stock at year 3 or year 4, your only option is to take the cash from that sale and purchase new QSBS eligible stock with that cash within 60 days. So it's sort of like the 1031 exchange. If you have folks in your network who maybe are a little bit more familiar with real estate property exchanges, it's sort of like a 1031 exchange for stock. So you take the cash and you purchase a like kind, quote unquote, asset with it. Now, the challenge with that is 60 days is not a very long time. And when you're a founder of a company who just went through liquidity and you just got your deal done and the whirlwind that is, now you're dealing maybe in a post-liquidity world where you're maybe running another team at the acquirer or you're otherwise involved, 60 days is not a long time to be able to find and diligence a new opportunity to invest that money into. And so it's just really not feasible, especially for founders, to use that cash to, say, buy stock in someone else's company. It just doesn't make sense, like risk adjusted, I suppose.
No, it's a miracle that your company did great, and now you have to go and find another miracle
Find another one,
and make it work within 60 days. It's crazy.
Yeah, that's probably the biggest barrier to executing them. Is for the longest time there just weren't a lot of people hadn't come alongside founders, I guess, to help advise them on structured ways that they could do these rollovers. Yeah, the options are risky. It's like take your money and invest it in Dave's startup in San Francisco. He's going to lose your money. So that may be what you want to do with that money and keep your risk profile sort of moving, but that's not tax planning in any way, right? And so if you're making that decision just to save, say, on federal income tax, that might not be the most efficient way to use your rollover. So we've seen it much more for angel investors as something that they might use. People who maybe have a lot of deal flow, a lot of investment opportunities in front of them, but want to keep that risk profile moving. So I'd say it's timing and risk are the two biggest challenges that you face when you're trying to execute a rollover.
As a detail on that, so if you have, you've got your company and you've got $10 million coming to you and hopefully tax free, similar to a 1031, you don't have to go into one company. You could go into a basket of companies.
Yeah, you could take the cash, say you make $10 million from a sale. You could pay taxes on $3 million of it, assuming you haven't hit your 5-year requirement. And then you could maybe roll over the other 7 in various other deals, or you could put it all into one new company. And what the rollover actually does is it continues your holding period clock from the last stock. So if you held for 3 years in your original company stock, you sell, you're able to reinvest those proceeds within 60 days, continues your holding period. And once you're beyond a combined 5, at that next juncture, next liquidity event in the second company, now you have, proper seasoning on your shares, quote, for lack of a better word. And then you can sell them under the QSBS exemption.
So, this gets to what you do on a day-to-day basis. But so a founder comes to you and says, all right, I've got this situation I think that's coming, and I need some advice. You're sort of letting them know what's happening here. How do you advise them in a sense, whether it's through your company or even as a general matter? Do you have a suite of other founders and companies that are out there? And then maybe also similar to a 1031, is there sort of an intermediary function that needs to happen in order for the asset or the cash to go into sort of for lack of a better word, like an escrow account to then be deployed correctly into the eligible next companies so that you keep that period going?
Yeah, it's a good question. It's not as formalized as in terms of the 1031 world, where there's sort of a designated intermediary, and that's sort of a required step in the process. This is very much the wire goes into your checking account for the sale of company A stock, and you send a wire back out to purchase stock in company B. When someone comes to us and is looking for guidance on how to do a rollover, sometimes they've talked to tax or trust and estate attorneys already, or maybe
Sure.
their CPA. And, there are maybe 50 folks in the US who have, I'd call it advanced QSBS planning knowledge, which is they have the trust planning strategies, rollover knowledge, all of these things sort of at their disposal that they can speak to. But it's a very small network. And so our firm is actually the only non-CPA, non-law firm in the country that deals directly with founders on these. And so we end up kind of playing quarterback, connecting them with the right attorneys, maybe the right CPA if they don't have one, to make sure that the team is sort of assembled. And so, because the risk profile of taking your money and investing in someone else's company typically doesn't align with most founders' interests at that time, the service that we provide is helping them to roll that money into a new startup of their own. And we think these founder-led rollovers, where the founder or the shareholder who sold their original stock can now direct the proceeds into a new entity that they own and control, is a really great way to execute these. Giving the shareholder, giving the founder the optimal amount of flexibility and control over the proceeds over time, sort of can handle their own risk profile.
So for the founder who, built their business originally, they sell it and you're sort of with them along the way to roll it over into another founder-led situation. Are there any mechanics that you help with to sort of ensure that takes place correctly? There's so many, it seems like so many tiger traps along the way that, you can stick your foot in and your intent was there, but maybe you did something weird or incorrect. Or
Yeah.
maybe a better way to ask this question is, what are the things in that receiving new QSBS rollover do you want to see, or a founder should make sure they have in place before they go ahead and pull the trigger?
We want to make sure it's a C corporation. First of all, a lot of times when founders start their first companies, they just incorporate an LLC somewhere and start doing business. A lot of times there's not even, maybe there's $2,000 or $3,000 transferred to a checking account, from their personal to their checking. That's how you start most businesses.
Right.
But when you're starting a rollover business, we have to see a couple other things. One is we want to make sure it's a C corp from day one. It's okay if it's a single owner C corp where the founder's the only board member, only director. It's it's your entity. That's fine. But we also want to see a purchase agreement, some kind of stock purchase agreement. So you can't just transfer money from your Chase savings account where the wire landed to the new business account and go on about the business. We want to see a stock purchase agreement, and so some of those agreements and the optimal way to do those for sort of the long run of the business. Sometimes we would obviously we have our template docs and ways that we might advise to do it, but very often we refer that out to legal counsel and coordinate there to make sure that just all of the purchase agreements and governance docs and those types of things are in a good place. It's really making sure we have the purchase agreements and that the money gets moved to the corporate bank account, the new business bank account, within 60 days. It's really not a long period of time. And we run into a lot of situations where if someone's not kind of quarterbacking the process, deadlines get away quickly, and then administrative issues with a bank might push you beyond the 60-day window. We've seen that a few times, and it can, obviously cost you a lot of money.
When you get to a point where the next business that this is going into, often the qualifications of being a QSBS eligible business can be a little bit murky. I'm thinking healthcare, for instance, where, like a hospital or that type of thing would traditionally probably not be a QSBS situation, but a healthcare service provider or a biotech company or something like that is. Do you help founders think about that? And in many ways, there's sort of the which came first, the idea for the company or the company itself. How do you make sure people stay on all fours on that front?
Yeah, I mean, if you build a startup before, that the ideas in the early stage sometimes are extremely malleable. And when you start testing things in the market, the business very often changes. We majority work with tech founders. And that's not because, QSBS is well suited for tech. I think a lot of people think that to be QSBS, you have to be a technology company. That's not true. It's just that we most often see QSBS and we run into people who are knowledgeable about QSBS in the venture space. So venture-backed startup, like traditional startup businesses, because 80% plus of those companies are tech businesses. And then the other 20% is manufacturing, biotech, life science, e-commerce, those types of things. But majority of people that we do these transactions with are in tech. And so by virtue of that, their rollover business ends up being, most of the time, ideas that they have are tech adjacent. So that's a great place to be. I'd say some things to avoid. What we hear often, people coming to us wanting to roll over into real estate in some way or another. And there are ways that the business that you start as part of a QSBS rollover can hold real estate assets long term, depending on the business type. But you have to be really careful there not to, in the eyes of the IRS, look like a real estate holding company or have too much of your assets tied up in sort of like passive real estate holdings. And so I'd say that's the murkiest stuff that we run into. But most of the businesses that we are helping founders start and grow as part of a QSBS rollover are B2B or B2C tech, either web applications or mobile applications, e-commerce stores. And we have a few hardware sort of based companies or like very physical product based companies as well.
For a lot of tech founders, the idea of taking some money off the table is important. And I would think that maybe partial QSBS situations come up. This isn't an all or nothing thing. You can take some money off the table and then allocate other parts, maybe
Yeah.
half off, and then the other half you can roll into the next company.
I'd say an extremely common situation that we see is maybe a founder in New York who is raising maybe a Series B, call it a $50 or $60 million Series B. We saw a lot of these size rounds with the AI kind of boom happening. And might be an opportunity to take, $4 to $6 million off the table as secondary at that stage in the company's growth. And so you have this founder who just got $5 million wired to their bank account, maybe their first money. They've been renting in a condo or apartment in the city, and they're still very much like in high growth stage with their company. So they don't have a lot of bandwidth to run a new business. And so they'll really try and de-risk themselves. That is, maybe pay taxes on $1 million, $1.5 million, give themselves a cushion right away, maybe buy a condo or, whatever, stabilize their life just a bit and roll over the other $3.5 million, and manage a project on the side that way. That's a really common situation we see.
For investors who are invested in a lot of different things, and maybe, they've got 6 or 7 companies that are QSBS eligible, and they are sort of rolling the dice on that and sort of picking and choosing which one should go into which, that type of thing. What's different about it from an investor standpoint than from an operator standpoint?
Yeah, I think the biggest thing investors have to pay attention to is if you receive a distribution that isn't QSBS eligible because of holding period, you cannot just take that money and invest it back into a venture fund and call that a rollover. The money can go into a venture fund, but that capital also has to be called and deployed into an investment from that fund. Meaning you can't just invest in the partnership at the partnership level in a venture fund and it sit there undeployed and be eligible for QSBS. It actually has to be fully deployed into target opportunities within 60 days. So that's something that I think that we run into a couple of times with investors is they think, oh, I'll just, fund 2 is open at, XYZ firm. I'll just roll the money over there. But it does have to be deployed still within that 60-day window. So that's something that we hear a lot of. If you're an investor, I would you don't always have the perfect deal ready at the right time, but keeping good relationships with the founders that you're partnering with, you never know when someone might be able to open up a tranche on the side or sell some secondary to you if you're trying to still get access to that deal sort of outside of a normal round.
So for the companies that are in your orbit, obviously you're probably checking in saying, hey, you didn't do anything to blow up your QSBS status. But for the companies that aren't that way, and let's say you are a founder and you've got a nice situation where you're able to take some money off the table and maybe put it into one another things that your friends put together or something like that. How do you think about a checklist, or what are the questions to ask to make sure that the recipient investor or recipient of the investment is QSBS eligible and will sort of stick to it?
Yeah, you want to ensure first that the company is small enough. And so under the old rules that I mentioned, the company would have to have less than $50 million of gross assets. So a really great proxy for that is just how much has that company raised. If you're trying to invest in a company and they've raised $120 million, it's very likely that they've at some point blown the asset test and they're not issuing QSBS anymore. It's not always, but it's very possible. A lot of people confuse that test for valuation, which is a mistake. You could have $1 billion company in terms of market value, with only $20 or $25 million worth of assets on the balance sheet. It is possible, especially in some of these high multiple, high growth tech businesses. And so, not confusing valuation with gross assets is one thing to pay attention to. The other is ensuring just that the company is a C Corp, especially for early stage investors. I'm talking like first money in, maybe before, seed or pre-seed, I would say, ensuring that the right structuring is in place such that you're getting stock issued directly from a C corporation at that time you're investing. So I'd say that's something to worry about more if you're, an angel who does a lot of sort of direct sourcing of deals and, you're not going through a fund. Most of the time, if someone's raised capital directly from a venture fund, all the paperwork and things that you're going to look for as far as QSBS are going to be in place. Because most VCs are pretty well acquainted at this point with, hey, let's make sure this is eligible before we get in here. Yeah.
And just to distinguish, an LLC that elects to be taxed as a C corp versus a C corp, is there any distinction there for our listeners?
Yeah. Generally, we would say as long as the LLC has made that C corp election before issuing more at that stage, I guess, membership units of stock, as long as they've made that C corp election prior to issuing the stock, then we feel generally good about it. But yeah, an LLC, it's an entity structure whose default taxation is as a pass-through, but an LLC can also be taxed as a C corporation and can issue quote unquote QSBS eligible shares or units as well. So it's possible.
So for the listeners out there, C Corp doesn't just mean C Corp, but the real operative language is that's taxed as a C Corp component, and that should be part of your checklist as you go down the list of companies to potentially roll into. So for those people who aren't exactly founders, but maybe are investors or otherwise part of businesses that they've been included in, et cetera, those non-venture backed businesses, what are the opportunities there for QSBS and then the ability to roll it over into other things?
I would say it's very rare that we see a non-venture backed business in between the coasts, I'll say, right? Like not one of these kind of call them coastal elite tech businesses. I'm talking about your legacy family business in, North Carolina. Most of the time we're going to see those as pass-throughs or partnerships, maybe like an S corp. You would see that type of structure, and those businesses, while they could be amazing businesses, the interest in them isn't QSBS eligible because it has to be issued from a C corporation. And so the most of the time, the planning opportunity we see with those types of businesses is around the time of maybe a generational transition or other type of transition planning where maybe the children take over from the parents and they establish a plan. Hey, we're going to take it over, but we want to plan to sell maybe the next, 5 to 7 years. I hear this a lot. An opportunity if you are in an industry, in a sector where stock sales are common in the industry for exiting the businesses, electing to be treated as a C corp or restructuring to a C corporation from one of those pass-through structures is an opportunity. Mm-hmm. Because you could sort of reorganize, reissue stock, now start your QSBS 5-year time clock. And, hopefully the business keeps doing well and you can have that exit opportunity down the line. And at that point, take advantage of QSBS. Again, the thing you want to pay attention to is that you actually be able to do a stock sale at that time because QSBS requires a sale of stock, not an asset sale.
Right.
And so that's a really important distinction. So make sure either that you're in an industry where that's common or you're working with counsel who understands what you're trying to accomplish before you make those decisions, about how you're setting your entity up at that stage.
Just as a comment from me, with the passage of the new law, and we sort of alluded to where previously you really didn't start thinking about this until fully 5 years. The new law, people can start thinking about it within 3. You get 50% of the benefit of the exclusion at 3 years. And I've run into people where 3 years suddenly seems like a short amount of time. Whereas 5 years, I think everyone was sort of like, oh, we'll get there eventually. Yep. And, they're fighting for their survival anyway. And if that happens to work, terrific. In this case, I think the law moving the timeline up a little bit has had an interesting impact on those conversion discussions, because I think people are now starting to say, hey, you know what, I can get to 3 years. And, with the speed and the rate at which things change at this point, it's much more realistic than I think it might have been going back in time.
Yeah. And if you have a stable business where you feel comfortable making projections, say 3 years out, so to what that business could look like at that time, it's really becoming more common now to do what we're calling choice of entity studies. Right. Mm-hmm. So working with someone who can model out with the difference in taxation, both at the company level and at the point of selling stock, what the optimal structure may be, depending on your time horizon to exit, your expectations for growth or lack thereof. And so that's something that some valuation firms, business advisories, some law firms or CPA tax advisories may be able to do. If you're in that situation, you're trying to figure out, hey, what's the math look like based on my baseline assumptions of what this business will be, and can help you sort of make those decisions about how to plan over the next 3 to 7 years.
As part of that reorganization, too, I've talked to a few people who are in, let's call it personality-based businesses, whether podcasters or influencers, or, other types of things that are a little bit adjacent to maybe typical software companies. And, I brought up the notion that, you may be disqualified now, but you may have a future growth opportunity within your business to make it fall more in line with a QSBS defined business. And so, if you've got the time and the ability and it makes a business sense, it may make sense to start thinking about either sectioning that off or developing that business line for something a little bit later on.
Yeah, being strategic about where those adjacent businesses, how they're structured and where they're built. And I mean where, like in terms of a legal entity level sense. I'm thinking about, for instance, several golf YouTubers who make a lot of golf content online, but now they're announcing partnerships to, design clothing, have their own clothing line, or maybe they've entered a joint venture with a golf club maker, or maybe an emerging brand, and they're taking equity. Those are really interesting options. And I think that you still have the opportunity to leverage your personal brand to grow that business, but separating them out so that, your reliance on your personal brand doesn't ruin QSBS. That's actually getting to one of the rules around qualified small business stock, which is that the companies can't be based on the skill or reputation of a single person. And so as when we think about like entertainers, athletes, social media personalities, Mr. Beast, for instance, couldn't sell Mr. Beast, the YouTube channel, necessarily as QSBS eligible interest because of that rule. More than likely. And that's obviously a broad brush, but paying attention to where you hold your business interests is important for this if you're in that space.
Any state thoughts? I know California QSBS is uncoupled from the federal QSBS, and New York threatened it, and apparently that got knocked down. New Jersey just coupled with the federal government so that people weren't scared away from doing that. How does that figure into your analysis?
It's sort of a battle of the coasts. It's like which coast of the United States is going to be most investor and founder friendly with relation to these things. Yeah, because California hasn't followed it for a long time. Oregon and Washington State are close behind there. And then we have the sort of somewhat the opposite happening on the East Coast. So as an East Coast guy, I hope it becomes a hub. But yeah, there is some sort of, state and local tax planning, strategic planning that you might be able to do if you have the foresight and, the right data to determine where you might become a resident or taxpayer prior to an exit. You might talk with a SALT attorney or a SALT advisor, state and local tax. These are usually tax advisors, CPAs, or tax attorneys who can help you think through, hey, does it make a difference whether or not I move from California to Texas? What does that look like for my family? What does that look like for my post-tax exit situation? Because where the company is headquartered, as long as it's in the United States, doesn't matter for QSBS. Just has to be a domestic USC corporation. And so remembering that QSBS is fundamentally an individual taxpayer incentive means that regardless of where the shareholders are located, you're going to be beholden to that specific state of where you live and their rules around QSBS.
Terrific stuff. Brady, we're winding down here. How do people find you and your company, and any sort of parting thoughts?
Yeah, I'm personally very active on LinkedIn, so you can find me there, Brady Weller. And our website, QSBSRollover.com. We also have sort of an open source QSBS advisory referral site called QSBSReference.com. And so you can find us at either of those places. We'd be happy to help you out and point you in the right direction.
Terrific. Brady, thanks for being on.
Thanks, Fraser. Appreciate it.